Let us welcome Deepak Shenoy, who is joining us on the show right now. Hi, Deepak. Good afternoon, and good to be speaking with you. And Deepak, once again, an interest coming in on the IT space. The last week, select counters did well. Today, of course, beat from Infosys, TCS, HCL Tech, Wipro. These are your top gainers today. What, as for you, is fueling the rally? Is it because of that AI bubble that a couple of these people are talking about, along with that, the Indian IT companies with respect to the discretionary spending still holding up in the US? How do you see the IT sector playing?
Thanks, Shashi. I think the problem with the IT sector has been that the uncertainty around tariffs has by and large made their customers wait for a long time before they would be able to make firm plans for taking things forward. Now, I don't know whether that's changed today, but I know that I think we've come to a point where tariff definitions have become much more prevalent, at least for most countries. So they are fairly sure that that's what the tariff situation is going to be, and therefore they can make plans. And what they've delayed for about 6 months now, they can actually put into action at least for the remaining part of the year, and perhaps moving into next year as well. So hopefully that's why the IT pack is starting to move up. But I don't think this is going to be a quick move, relatively speaking, upwards, unless there's some big announcements that happen from a geopolitical perspective. Because everything that happens now from now on will be very slow, and it will just kind of make up for the lost revenue in the last 2 quarters. So it may not mean a meaningful long-term change right now. And eventually, as we see the impact of AI, see the impact of maybe some of the new initiatives of some of these companies, some of the players in the IT pack will actually do significantly better, in my opinion. Once they have learned to be more lean and mean, cutting off the fat and kind of progressing towards revenues from more disparate sources using AI itself. But these are long-term things. What happened today, again, I have no idea.
Well, that uncertainty is there for sure, Deepak, in the markets. But if you talk about some other pockets, today a lot of support is coming in from indexes like realty, metal, pharma is also holding up pretty well. What's not doing all that well is the entire banking space. Now, all the managements that we've been interacting with, everybody says that the NIM pressure seems to be behind, and we have at least bottomed out on that front. What's your outlook going ahead for banks? And at this point, are you liking the PSU banks more or the larger private banks?
So, by and large, I think we won't take a view on PSU versus private right now. I think private banks in general have become more attractive because valuations have come down. But Snehi, the problem in the banking space is now one of the fact that rates have come down, and there's pressure for lending rates to come down sharply from here. That pressure is going to show up in terms of competitive rates, in terms of both secured and unsecured credit NIMs contracting, because short-term rates have fallen quite significantly. Long-term rates, even the GSEC is about 100 basis points above the repo rate, and corporate is even above that. So, the point is banks haven't reduced rates meaningfully in the last 2 or 3 rate cut cycle changes. And I believe that if they don't, then that competitive pressure will start building up, and that will kind of bring things down. The second layer is this real money gaming ban, which probably reduces transaction velocity in a lot of banks that were maybe primary in terms of supporting some of these transactions. As UPI has shown, about 35 crore transactions were done for real money gaming alone just in the month of July, I think, or June. So it's a fairly large sector to kind of see revenue crunch in when it comes to banking, because they were getting a lot of float from the real money gaming players, and that much float will also go away. So maybe these are the two reasons why we're seeing some layers of weakness. But by and large, bank valuations have come down quite significantly, and I think to in some cases the private sector banks are actually more attractive than the public sector counterparts. where there seems to be a lot more froth building in. Though they've performed quite well recently, I still feel that the PSU bank valuations leave little room for improvement.
All right, so that's the take coming in on the banking space. But Deepak, we'll get back to you in a while. But before that, let's also address the credit rating from Fitch that has affirmed is long-term foreign currency issuer default rating for India at BBB negative, citing strong economic growth and resilient external finances. Let's go across to Anurag Joshi, who is here with more details on this one. Anurag.
Fitch Ratings has affirmed India's sovereign credit ratings at BBB minus with a stable outlook. Fitch, in a statement, has said that India's ratings are supported by robust growth, solid external finances, and a strengthening record on delivering growth should drive a steady improvement in the structural metrics, including notably the GDP per capita. The increase is likelihood of the debt of the country trending moderately downwards in the medium term, and the fiscal metrics are a key weakness according to Fitch, and that also includes high deficits and debt servicing compared to BBB peers, which Fitch rates. In terms of the economic growth outlook, Fitch has kept its forecast for FY26 India economic growth at 6.5%. That's unchanged from FY25. Domestic demand will remain solid. That is underpinned from public capex and private investment. Private investment is likely to remain moderate, and particularly given the US tariff risks. Fitch has also touched on US tariffs, and it says that US tariffs are a moderate downside risk but highly uncertain. In terms of the MPC and its rate outlooks, Fitch says that the low inflation CPI in India now, that gives space for one more 25 basis points rate cut in 2025, and falling food prices and RBI's policy actions are keeping the headline inflation constrained.